we're excited to have you today. It's the founder and VC experience, and then we've added a third dimension, which is kind of the point of view from the legal perspective. So we're going to go through some different things that are really key from both our experience as a VC, as well as from a founder, and then as an attorney, and then we'll go through some Q&A. So definitely, please feel free to ask us any questions. And then towards the end, if anybody's a founder in here and wants to come up and pitch, we're going to give you a chance to give us a 2-minute pitch and ask some questions, and we'll put you through the gauntlet. But have a lot of fun with doing it. So, to start, I just want to get an idea of who do we have here. Do we have any founders? Raise your hands. All right, great. Who's first-time founders? Okay, cool. Anybody just part of a startup but not the founder? Okay. And who here is, do we have any angel investors? And any venture capitalists? And I don't want to leave Tom out. Is anybody an IP attorney? All right. I was not expecting that. Awesome. So I want to introduce ourselves. I'm Ryan. I'm with Florida Funders. I'm our Chief Investment Officer. And so I'll tell you a little bit about our perspective. We see about 1,000 deals a year that come through our portal. It's mine and my team. Some of our team members are here in the audience. It's our job to really go through as many of those deals as possible. We do go through all of them and give them the time of day and try to make an educated decision on whether or not they're going to make the cut to the top 2% that we'll actually fund. With us is one of those companies that we actually did fund, and a very exciting Orlando's own founder, Tomas Diaz from did I say Diaz? From Plex Engage. And then we have Tom Stanton, who's an IP and patent attorney, also was a prior founder, and he also sits on our investment committee for our seed fund. So we'll get some great diverse opinions today. So I thought to start, it would be important to kind of go through what does a VC look for, and then I'm going to kind of share that in with some questions with them. The first thing, and this is probably the number one criteria that we're looking for, is the founder and their management team. How prepared are they? How resilient are they? Are they coming in and are they prepared with their numbers? Were they prepared for their pitch decks? We've seen, so many countless times somebody's not prepared. Oh, I didn't know that I was supposed to share my deck with you. Well, we're trying to see 1,000 deals a year. We're not going to reschedule this and have conversations. It's business, and we have to get through that. And so, being prepared, being resilient are some of the key aspects. Being hungry, being willing to sacrifice and not looking for a handout, but showing that, our interests can be aligned with yours to ultimately get towards an exit. So I think the first question, Tomas, I've told you guys, we see 1,000 deals a year. You're one of the 10 to 20 that we're going to invest in. What characteristics do you feel like that a founder needs and maybe that you shared?
So, and is your question, what characteristics does a founder need in general, or do they need to get money?
That's a great point. I would say in general.
All right, so in general, right, I would say, and I think, many of the founders, maybe know this or have this, so, I'll give the general feedback is, a founder, in my opinion, has to be very optimistic. I think sometimes it's you're going to get a lot of no's, whether it's from VCs, whether it's from your customers that you're trying to pitch, whether it's whatever, you have to be able to shake the no's and continue pushing forward. I know that there's a fine balance with that because, sometimes the VC will say, yeah, but, if you have a, dog of a business, then, what does that matter? But you do have to just continue charging forward and despite all the challenges and the obstacles, you have to look through break doors. And I think you have to be a sort of optimistic a little bit for that, because, and I think you called it resilience. I would maybe add on to that, it's resilience, but with optimism of like, all right, I got that no, but what do I have to do to get the yes, right? What do I have to do to keep pushing forward? I also say that it's a bit hungry. I'll tell you, I think about this all the time. Being a founder is not easy. It's like somebody kind of mentioned this. It's like being in a bare knuckle, fight, every single day with somebody. And it's just like you have to continue figuring out dodging, moving, how to attack, how to continue, because it's not easy. There's a lot of headwinds. To create something from nothing, there's a lot of inertia against you, right? So you have to push, you have to be hungry. And I think that those are some of the skills that I would offer. Hungry, resilience. I would agree with you on that.
One of the key words you used was optimism. So how do you balance that with realistic expectations? I think optimism is a great trait, and it's something we're definitely looking for, but we also want to see realistic. And how do you keep that from, if you get a no, how do you break that down and go back to learn from that experience and go to the next VC, being optimistic but realistic with what you're asking?
Yeah, so this is a very fine line, and I think it's a skill. It's hard to teach, and it's something that you have to be. I think there has to be a little of intuition that comes into play here, because you're right. You could be optimistic, and it's almost like you can beat your head against the wall so many times. And a lot of people, a lot of founders, just keep saying, "Well, if I just keep trying this and I keep trying that," at some point, what you have to be, I think, really good at is getting feedback and listening to the feedback of so if you're getting a no from a VC or you're getting a no from a potential customer, why is that no, right? So a lot of times when I would get feedback from a VC or a customer, I would listen to it and say, is this something that's unique? Is this something that I should be listening? Is this something that I'm hearing time and time again? Is there a pattern that's emerging? And if there's that pattern, then maybe I have to rethink I have to rework my thinking on that. Maybe it's not as beautiful, I think, because a lot of entrepreneurs that I hear say, well, the VC just doesn't get it, or my customer just doesn't get it. If they could just see the way that I would see, that I see things, there's a very dangerous game in that. So I think you have to be intuitive and listen to a lot of the feedback and say, okay, well, if I'm hearing that from a VC or if I'm hearing that from a potential customer, what does that mean? And are there tweaks that I have to make to my business model, to my pitch, or whatnot? So I would say optimism, but with intuition.
Both of you guys having founded companies, did you ever have a moment where you looked and you said, man, I just can't do this, or why did I do this? This is too much on me. And what kept you going?
I'll answer mine.
Thanks. Just to give a little context, so I was a computer engineer in undergrad and started an IT managed service and software and development company out of undergrad, and then ended up selling that and then working for that company, getting bored and studying at a law school, and so here I am. But so with that context, I think the answer is every day. There was an interesting thing my senior advisor told me when I was debating about going to work for Harris Corporation as a developer or going to start my own company, and he said, "You're like the general that doesn't know he's surrounded. You just have to charge forward, right?" And so blinders or ignorance can also be a blessing, especially early on. You don't want to be so ignorant you're running into the wall, but you don't want to be so knowledgeable that you're paralyzed. So I think that's...
On the question of, are there days that I'm like, what am I doing? I would say I have at least that once a week, at least, and I've been doing this for several years. Entrepreneurship, there's a lot of highs and there's a lot of lows, right? When we get a new customer, it's like, oh my goodness, we are the best thing that's ever happened. This is amazing. I can't wait till we get the next one. And then there's times when you lose a deal or you don't get an investment and you're like, why am I doing this? This is so hard, right? But I think, what pushes me? So I'll this is very personal. It'll be very personal for every entrepreneur, I would say. For me, what pushes me is, I see that there's been a lot of successes that we've had in the past, and what pushes me is that motivation of trying to accomplish something bigger than myself. We're building something really amazing. So I think it's a sense of accomplishment, number one, a sense of doing something myself. I think a lot of you are entrepreneurs because maybe you worked at a corporation, maybe you work for somebody else, and you're like, why can't I do this? So just the feat of accomplishing something that is your own and molding building it. So I think that sense of accomplishment, I'm not going to lie, there's the payout is also, something that drives me, and I know that that's what drives investors is, the payout of making something big and getting some financial returns. But then the last thing that I think drives me is the people that are behind me. So my investors, my family, the employees, it's almost like I can't fail. I cannot fail because I cannot let the investors down. We cannot let our employees down. I can't let my family down. So it's just that drive of not failing. For me, that's what drives me.
That's really hopefully helpful to everybody. And so one of the things, this is going to sound like a funny question to you, but I'll tell you, give you a little bit of background. So my question to you is, what do you do on the weekends for fun? Or when you're not working, you got to take a break. And that sounds like a silly question here, but there's a really interesting study we saw recently. I think it was from Andreessen Horowitz. And they started asking that to every founder because they realized some of those traits that really make a successful founder is they're passionate, they're committed, and when they have this passion or committed to something else outside of work, it's kind of evident that it also rolls in and it keeps them a little bit balanced because you need a little bit of downtime. You're going to go crazy if you're trying to do this 24 hours a day or if this is the only thing you have. So, and also shows commitment. If you're all over the place and you don't have a passion, you're wondering how committed are they going to be to their own company.
Thanks. For me, it's always been pretty just staying active. I golfed a lot. I was in martial arts for a long time. I'm still training jiu-jitsu. I like to run. To me, that's kind of my release, if you will. And if you see me starting getting really agitated, it's probably because I haven't worked out in a few days or something like that. So for me, that's really the piece there. As far as other kind of creative hobbies, I've found I'm not terribly creative. My mother's an artist, and she kept all of that skill set. So
I think it's a really good point and a good question that you bring up. So I'll say my answer, maybe a little taboo, in this kind of room, but I'll say it anyway. For me, I'm a very faith-based person. So, on Saturdays actually is a holy day for myself and my religion. So I completely unwind, leave my phone at home, and just focus on religion and do different things like that with the family. So I have one day where I don't even check email. I completely go and focus on my kids, focus on God and all that kind of stuff. So I completely check out for that one day. Now I'll be honest in that my mind doesn't check out because it's still always racing. But at least my connection to my phone and the email does turn off. That's for me is our Saturdays, and then on Sundays I do try to spend some family time and sports and things like that. And then I also do try to get a jump on the week. I try to, what do I got coming up on this week? What's important? And that's the day that I kind of I organize my thoughts for the coming week.
Thank you. Hopefully you guys all can see that there's a real reason behind that question and that, from a venture capitalist perspective, we're worried about burnout. Is somebody going to get burned out trying to do this? I mean, it's not a short and easy road to get to an exit.
And sorry, and I would actually just say this. I just told my wife this week. If it wasn't for my faith, I would have quit being an entrepreneur a long time ago. So.
Thank you. So, let's talk about, the most frustrating thing. I think one of them is obviously getting a no. You're trying to raise capital. Entrepreneurs believe in their company. I mean, they have unbelievable passion because they're spending everything, all their time, their money. Maybe they're sleeping on a couch. They've given up everything to build this, and then you get a no. So, how frustrating was that?
Oh, my gosh. Fundraising and talking to people like this guy are probably the thing that I hate the most. And I'm just being really honest, and I think that's the reason he invited me here. Now, Ryan and I are good friends now. And I even texted him, told him that I missed him, the other day. So it's very frustrating to get no's. It really is. And, the way I look at fundraising, for me, so actually, we were very fortunate to go through a program called Y Combinator. I don't know how many of you know it, but it's a really prestigious business accelerator. And in that program, we got the chance to commiserate with some of the entrepreneurs that were raising money at the same time. So it's a group of people going out raising money all at the same time. We recently just raised our Series A, which is what Ryan alluded to. And so there was about 20 or 30 of us in this particular batch. And I could tell you that each of us talked to between 50 to 90 venture capitalist companies at any given at that particular point in time. Out of those, so I'll speak to myself. Out of the 90 companies that we talked to, we got 85 no's. out of, so think about this. You talk to 90 companies, and out of those you get, 85 no's. So you get a lot more no's than you get yeses. And these guys give a lot more no's than they give yeses. But the point there is, again, as I mentioned, one of the things that I've learned about fundraising is that you have to take a no, and you take a no, and that's it, and you move on to the next one. Not all businesses align with the venture capitalist thesis, with their interests and their wants. And one of the things that I learned pretty quickly on is, if you get a no, it's not about spending 1,000 emails trying to convince that VC to say yes again. It's like, okay, I appreciate it, move on to the next one. And so, you learn, you ask for feedback about why there was a no, right? And then you say, okay, great, we'll take that, and you go. Because what you learn is those VCs that are interested in your business, they get your business, those are much more valuable and helpful for you in the long run. And trust me, it's very hard to reconvince somebody like in the spot. You can come back to them in a year or 2 years. I was actually told that, you're not going to convince somebody in a month or two, but you can come back to somebody in 6 months or a year if things materially change with your business.
And has that happened? Have you gone back to an investor that originally said, it's not a fit right now, but maybe later on? Because I know we do that. I think founders sometimes take as disingenuous, but it really is. It may not be the right fit at this moment, or we need to see a little bit more traction. And that's not us blowing you off. It means I'm not going to waste your time. I know our internal process. And for you to get through our process, through due diligence, to our investment committee, I'm saving you the hassle and allowing you to go to somebody else or focus on your business right now so that you don't get a no, and then that door is shut. I'd rather have you say, hey, I'll take the advice. 2 months from now or 3 months from now, I'm going to show you a little bit more traction and prove to you what I was talking about. And now I'm coming back stronger, and I have a much better shot when I go through your investment committee to get a deal done.
Yeah. So yes, the answer is yes. So we just raised the $6 million Series A. We haven't formally announced that, but press release will be coming out in a little bit on that. But the lead investor is a company out of Silicon Valley called Bullpen Capital. They actually told us no 2 years ago when we were doing our seed round. But they said, hey, listen, come back to us when you're doing your next round. And they were honest about that. And actually, many companies that did tell us no in their seed rounds had come back to us when you're ready to raise your next round. And we did. We went back to them, and all of them gave us meetings. So they are honest when they say come back to us if you have material changes. But again, like I mentioned, when they said no to us in the seed round, I asked why and what they would be looking for in the Series A. And having known all of that, I went back to them and I said, hey, you told me to come back to you in the next round. You said that to come back with these kind of metrics, and this is what you'd be looking for. So we've done that, plus all of these other things. Are you interested in now? And so, yeah, that just happened to us just now.
That's awesome. So one of the things I think from a founder's perspective is, when's the optimal time to raise funds? And Tom, I think you should weigh in here too, is how you're counseling companies and what they're looking for. When's the right time? I mean, there's an aspect that we want to see a company bootstrap and make the sacrifices, but you don't want to take that necessarily, in my opinion, too far to avoid dilution. And now all of a sudden you've got a company that's been slowly, steadily growing for too long, and the competition's lapped you in the meantime. So to me, and from our perspective, there is some sort of balance there. And I don't think there's a definitive answer. There's not a definitive time frame, but there's an amount you want to raise, and there's a timing to that. So I'd love if you guys want to comment as to, Tom, maybe how do you counsel a company, and when's the right time? Is it right when a train's going by?
There's no better time. It's a very great question, and it's a very complex question. It depends on the type of industry you're in, of course. It depends on is the investment really going to create some sort of a hockey stick type growth, or is it still going to be gradual, right? Because going to raise money means you're getting a boss, right? You're giving away some of your company, and you're getting a boss from that. And so it has to be looked at very seriously. I see a lot of startups that are caught up in the money fundraising phase and just want to raise money to raise money. And if you take the amount of time you're trying to raise money and go sell your product, you may not have to raise money for a little while, right? But people want to see their headlines saying, we just raised $1 million or whatnot, right? So it needs to be looked at from that perspective. The two key criteria that I advise on are, one is, do you need money because you need green, or do you need money because you need strategic partnership or a strategic advisor to help your firm or your company grow, introduce you into certain markets or certain potential clients, provide some sort of intangible assets, if you will, to your growth. So those are very important things to look at. And then when do you go in, right? If you're going into some sort of a software development platform that you're going to need 3 to 5 different rounds of funding to get to where you want to go, you got to be very careful early on, because if you give away too much, you're going to have a really hard time getting there and not being diluted down to 5% or something, or 10% of your own company, right? So those all play into it when we talk to our clients about that. And it really just depends. I think the golden rule to live by is don't raise money if you don't have to. I think that, it's not always the case, but if you kind of live by that, and, you also show investors that you're willing to put your own skin in the game, right? Sometimes people go, oh, I'm here, I put a few bucks in, I have a bunch more money, but I don't feel like putting it in, I want you to take the risk, right? That's not, investors don't like to see that. Certainly at a startup phase, right? If you're a proven, well-established post-revenue company, you get a little bit more leniency on that. But those things are very important, and it needs to be analyzed carefully.
There's a couple of things that he said that I think that are really important, and we made some of these same mistakes. A lot of times people just focus a lot of their time and energy on fundraising instead of building a company, and we were part of that. Like in our first year, like we got to go and get all this money because we want to get paid and we want to quit our jobs, and because we believe that that's how we'll grow the company. And we spent really the first year just with a PowerPoint deck trying to raise money. We spent a lot of time, what I think is wasted time on that. So I would agree with that. Then I also think that it depends on where you are in the cycle of your company and what type of funding you're trying to get. So there's friends and family, early stage money that you can try to get, obviously from really close acquaintances. There's seed money, right? And then there's, venture capital money, right? And so there's, Series A's and on, and, we can talk about the differences on that. But your question is, when is the good time to raise? And I like to think about, fundraising as storytelling. Really, it really is. And one of the best advice that I ever have is that investors invest in momentum. Think about that. Investors invest in momentum. I think that said in another way is, you invest when there's traction. Investors will invest when there's traction in your business. And the reason I believe that they do that is because obviously they're looking at a portfolio and they want to try to de-risk their investments. And obviously if you have momentum, if you have action, if you have something behind your business, for them, that looks like a less risky investment than somebody that doesn't have, any momentum, that doesn't have actually, prove it. And one of the things that Y Combinator taught us is that the biggest way that you can demonstrate traction is by people paying you for whatever it is that you're building, right? Sales, money, whatever it is. So, and a lot of people say, well, I'm not a salesperson, or I'm not, I can't go. If you can't prove to somebody that that people are willing to pay you money for whatever it is that you're building, it's going to be tough for a professional investor to fund money. Now I'll be honest, so there's other ways you could do that. Like in the beginning, we actually went and from friends and family, got $400,000 and $500,000 or $500,000. And, those people are willing to, bet on you just because they know who you are. They know okay, if I back this guy, there's a chance of doing something there. So we went out and we did that, for people that weren't necessarily looking for sales. But we used that money from friends and family to go out and get our first customer, get our second customer. So then we could go out to venture capitalists and say, hey, we got customers here. We're onto something. Why don't you fund this? And that's, for us, was what made the difference happen. And for me, that's where how I think you should approach seeking investment dollars is you have some proof that you have a business, that it's just not an idea.
One thing they mentioned too, I think it's important, is know who you're pitching to and know what they're looking for, right? So like at Florida Funders, on average, if we're getting 5 to 10x, we're pretty happy. So if you're coming pitching 100x or 200x returns, right? It may be there, right? But you're generally looking more for a gambling type investor at that point. So know who you're pitching to, right? And so I think, when we look at some of these deals, if they're showing, they're going from 0 to, 50 million revenue in the next 6 months, it makes us scratch our head a little bit, right? Hopefully it happens, right? But, so if you show it a little bit more conservative, you want to show that there's market share, of course, right? And all of that, and there's potential. But I think it's important to know who you're pitching to. Don't have the same pitch deck for every single investor, because some like to gamble, some like to be more conservative, even at early stages.
Point of clarification, we do like 100x. But I do like realistic expectations as well. I don't want to eliminate anybody here that might be considering and you have 100x lined up. So one of the other things I want to just add to that is raising the right amount of capital, and especially at the right stage. So we see a lot of seed. We launched a seed fund recently, and it's a little bit frustrating when the seed company comes in, says we're raising $5 million. Okay, why do you need $5 million? Well, that's going to take us for the next 36 months. And we're kind of like, all right, you haven't proven anything. You have a beta model. Why don't you raise $500,000 or $1 million, and let's prove it, and then you're going to have a better Series A round, and you can raise $2 or $3 or $4 million at that time. And it's kind of timing it and finding out the right planning, and having a plan for that capital. So if you come in, we just had a company that's going for their Series B, and we sat down with them this weekend at a conference in Atlanta, and they were asking us, we want to raise $20 million. And my advice is, I think that's fine, but when you get ready to pitch that, tell the investor, here's the minimum I need, maybe that's 16 million, 20 is our target, and here's why, and here's how we're going to allocate that. So be specific. Don't put it in 4 general buckets on a PowerPoint and expect us to just write a check for that, because we want to really understand, like, how are you using this capital and why. So that's just a point of advice. And so I think that kind of transitioned us to the next section, which I think is really important. These are avoidable mistakes from a founder when you're pitching to a VC. And these are not one-off things. I'd say if our deal team, we see this stuff on a weekly basis. It's probably closer to 50% of the time we see these things. So they're so common, I just feel like we need to address them, even though they may sound like, almost duh. So the first one is not being prepared. And it sounds ridiculous, right? But you get your shot. An investor, I've said it a couple times, and I'm going to keep saying it throughout so you can understand. We see 1,000 companies a year. I don't get to give you the opportunity to have multiple shots to pitch us again and again because you screwed up or you forgot the timing. Or the common one we see is, hey, I didn't realize we were actually going to be pitching to you. I don't have a deck today. I just thought we were going to talk about it. And my calendar is so full every day trying to carve out time for you. This is your shot. Like, I want to give it to you, and I can't wait to hear about your company, but be ready to do that. So just being prepared is probably the first item that is such an avoidable mistake. I guess, I don't know if there's a question here, but if you guys have any comments on that or things you did to prepare.
Yeah, I mean, fundraising is not just something that, you take lighthearted. And I think that goes just back to a lot of people that, will fundraise just because they think that's what you have to do when you're a founder. Like, oh, okay, I want to start this idea, or I want to start this company, so I got to go out and raise. Let me just talk to a bunch of VCs and do this. Now, I will say, in my experience, there's 2 ways that you can do this. If you don't want to pitch like a deck, advice that I would have, which I've done, is, hey, if you could grab, hey Ryan, can I take you out for coffee? Or I'm going to be in the area. Can I get 5 or 10 minutes of your time so that when I go to pitch you, I know what I'm looking for. Or I know what what you guys are looking for.
Absolutely.
So that you can do without a pitch deck,
Yep.
right? And which I've done that to, I'm like, hey, well, what's your investment thesis? What kind of, how much money do you guys put in seed rounds, right? So when he's talking about like how much to ask for, it's also fund specific, right? Because sometimes a fund can only do up to $500,000 versus, somebody may only be able to do $100,000. And if you're coming in asking for $1 million, they're not going to be able to do that. So asking for, trying to do homework, asking for some of these ahead of time, I think is good. And then when you are going to pitch, to your point about being prepared, I think that this is one of the things that we've done pretty well is, you got to know your numbers. What are you going to do with what are you going to do with the capital? But then, what does it cost you to get in a customer? How are you going to go get these guys? You have to. I mean, it's like you're giving them a business plan. And instead of you guys may have done this, instead of writing a business plan, like people used to do back in the day, when you go to pitch a VC, it's like giving a verbal business plan. And so you have to be prepared to answer all aspects, of your business. And I think that's what you guys look for.
And I'm getting the signal that we have about 15 minutes left, and I want to make sure we give time for somebody to come up here and pitch to us. So I'm going to give you some quick, just other pointers, so everyone's kind of aware of this because they see it too often. One is transparency. If we're asking you a question, it's not meant to be like divulging into your personal information. One I ask a lot is, you tell me you had a successful exit. Well, tell me about that. How much did you make? How much was the exit? How much did you make? How much did you put into the company? And I've had founders get really angry about that question. Like, I don't understand. Why does that matter to you? That's personal. Or they'll give me, well, I made a good amount of money. Well, the reason is I want to know whether you have skin in the game. Are you incentivized, or did you make $10 million and you put 25 grand into this company and you don't really believe in it? If you made 500 grand and you put 50 grand into it, okay, that's a decent chunk. And you may have a very good valid reason for not putting more in, but it just help us and be open and honest with us. We have a deal right now that we've spent probably 5 months looking at, and I just got word yesterday from someone else of a problem with this deal. And this person could have saved both of us a lot of time had they been transparent. And now this deal's, it's going to be over. There's no coming back from hiding this fact. Had they been upfront about it, I think it probably could have been something we worked around. Being unrealistic about valuations. We've had some recently, and we're looking for 50 million. It's not really Shark Tank. I mean, it's fun for the show, but coming in and offering us 2% on a 50 million and you're in beta mode, it's just not going to happen. But I do see that so often. So really maybe get some other advice, talk to your attorney, talk to other founders, hey, here's where I'm at, what do you think? Because you're actually going to jeopardize your next round. Even if you find somebody dumb enough to do the deal, and it does happen, there's a lot of angel investors we see will invest in it, and they're not as precise with terms. That can cause you bigger problems down the road after you've gotten the traction, because a VC is going to look at it and say, no, there's no way. I'm not investing in that. Now you got to do a down round and tell your other investors why you have to back it down. Here's another one. Thinking we're business partners after your deal closes and we're your best friends. It's a business relationship. We're here to support you and we want to help you. But when you come back for a next round, we don't owe you that money and we're not giving it to you. If you earn it and you've demonstrated what you said you were going to do, it doesn't mean you hit 100% of your projections. But maybe you've got an explanation and you say, hey, I'm ready for my next round. I've met these criteria. Here's why I'm going for this. And you're pitching us again. You don't walk in and just say, I'm ready for the check. It does not work that way. There's not a VC out there that guarantees the next round of funding. And lastly, kind of answering questions poorly. There's a lot of people on an investment committee. There's a lot of people you're talking to, and time is of the essence when you have an hour, and we tell you, hey, we have an hour set aside for you. Don't ramble on and on and on a particular subject and get into the minutia. And train if you have other people. If you're bringing your CTO or somebody else, make sure they're aware. We had a product demo that went for 45 minutes the other day into the minutia, and it was like, attention spans are short these days. Our attention, we're normal, we're humans, and you totally lost us, and we wasted 45 minutes and got to a no. And the last one is probably might be the most important. Know your numbers. The worst thing in the world is if you come in and your pitch deck says one thing, you verbally say something else, and then we ask you about it and you can't reconcile it, and then you tell us, why I don't do any of the numbers. I outsource that. If you're a founder and a CEO, you're the leader. You should know your numbers. I don't mean you have to take a test and pass every financial expertise out there, but but just know in general how you got to those numbers. Why do you have that? We're not even really looking at your numbers. We're really looking for your thought process. So a key question here is, Tomas, what mistakes did you make early on?
I think one mistake I already alluded to, that we spend too much time fundraising versus actually trying to build a company. We wasted a lot of time on that. That's one. Actually, one of the things I used to say early on, this is I think it's a common mistake, but we were fundraising, and at the same time we got an offer from a VC and then an acquisition, what we thought was an acquisition offer, like really early on. And what I'll tell you is, if you haven't like actually produced a product and you don't have sales, acquisition offer doesn't really mean anything. So we had another founder at that point in time that really wanted to sell the company, and we actually ended up jeopardizing a VC deal at that point in time. So one of the things that I would mention is, acquisition, know why you're doing this, and, acquisition offers really early on don't make sense for companies. And I think that would be it. Yeah.
So just to keep us on track of time, because I've messed up my own words here. I'm telling you guys to be cautious of your words, and now I'm running over time. So one thing I think would be really helpful for everyone here is, because, Tomas, you've had this experience. You've raised money here and in California. What are some of the differences? And we're seeing valuations.
Other than Florida funders, I would say there's a lot of differences in the sophistication level. And what I mean by that is, Go ahead. No, just meaning this. And outside of Florida funders, like some of the questions you asked, and I was, Saxon and I were talking about this. Some of the questions that we get asked is, from some of the angels, they want to go deep on like, what's our security models and what's, all these type of things, and you're like, does that really matter? So there is a little bit of a different level of diligence that I think happens here versus in the West Coast, I think they've just seen more deals. So I think there is a little bit of there is more due diligence that I think like happens in rigor here. So I think you just have to be ready for that and know that.
Tom, let's get you involved from a legal perspective. A founder's starting out, what's the appropriate time for them to come to you, to an attorney? What are some of the advantages of a big firm versus a small firm? What types of maybe structure should they be considering if they're early stage? There's a lot out there. There's a safe, there's a convertible note. We've seen startup companies with no viable product yet looking for a priced round. What do you counsel a company to do?
So I think a couple things to keep in mind with that. One is, as your attorney, we're not going to take over your job as CEO. And what I mean by that is sometimes you come in and and you're starting up and you're a little nervous and you're not sure where to go, and so you think, oh, it's an attorney, I trust them. Tell me what to do, right? We're a tool that we're only as good as the information we have. So we have multiple clients, right? We don't have all the information. We don't live your world every day unless you're in-house counsel or something like that, to where we can necessarily make those decisions, but we can guide you with the right information. So on the flip side of that is, be transparent with your attorney. I know it sounds silly, but sometimes people get embarrassed by certain things, whether they don't feel like they're sophisticated enough or whether they don't feel like they want to disclose certain information. But if you come to me, let's say for something simple like a potential competitor is infringing on your trademark, if you don't give me the full picture that you want to go after them because you're thinking of entering that market, and here's why you think that's going to be an issue, and so on and so forth, and you just say, I want to go after them, right? I can't necessarily guide you very well if I don't have that full information. So being open about all of that. As far as choosing a big firm versus a little firm and things like that, that really depends on the situation. There's always the kind of obvious one of cost and things like that. That's not always necessarily true, but some of the advantages of a big firm, I'm obviously with a small firm, but with a big firm is, let's say you have a lot of international type needs. Well, having and speed is of the essence. So if you're in multiple countries and you need things done in a quick format, right, and you need to be able to whether it's import goods or enforce agreements in certain areas, things like that, a big firm's probably going to be better for you because they'll have hopefully offices in those areas where you're operating. If you're local, a small firm can be just as good, if not better, and oftentimes lower price, and sometimes can provide you a lot more concierge type service. So, at the end of the day, I think part of it is the attorney you're working with, of course, right? You've got to be able to trust them. You've got to be able to feel like they understand your business and understand what you're trying to accomplish, and have experience. If you're in a startup mode and you go with someone that's been with an enterprise level accounts for their whole career, they're probably going to miss some things. So I think that's an important element that you need to kind of look at when you're deciding on who to hire counsel. Real quick. Yeah.
One other learning that actually I would say that as it relates to this is don't let your attorney negotiate a deal for you. So what I mean by that, no offense, is we let our attorney sort of be the one that was just negotiating the deal with VC early on, and a VC called me back and said, "Deal's off. You're an amateur if you're letting your attorney negotiate for you. You should negotiate your own deal. The attorney's there to help you. They're not your negotiator." So just FYI for you.
A lot of people don't know this, but I'm actually an attorney too, and I grew up in a family of attorneys. And one of the things that I learned very early on, I was told, was make sure your attorney understands that at the end game, they have to get to a deal and close that deal. Their job is not to go on and argue small points forever and ever and ever to run up your bill. They don't have to win every point. At some point, you end that and strike the deal, and you get the best what you can for both sides. Both sides should have a win-win in this. I want to skip ahead a little bit. I promised everybody if there's a founder that wants to come up, we'll do a little Shark Tank style. All right, you're the first one I saw. Florida Funders is not promising an investment, but what I can say is if we like it, I can accelerate you through the process. Doesn't mean anyone else in here cannot invest. So with you, I will turn the microphone over to you. I'm going to give you 2 minutes to give us your pitch, and then we're going to ask you some questions.
Thank you. My name is Tarek Shrew. I'm one of the co-founders of the Roro company. So I'll just get right into it. Global trade of large assets moves too slowly. It's easy these days to purchase construction machinery, automobiles, boats, trucks, and more through online auctions like Ritchie Brothers and Manheim. But to ship these items means relying on a subset of shipping companies called freight forwarders. The industry average response time just to get a quote is 3 to 4 business days, whereas Roro.com allows you to quote, book, and manage your shipments instantly. So the Roro company is the only provider of digital Roro services currently in the global logistics market. Excuse me. We ship currently on Roro.com from 21 different ports in the U.S. to 150 destinations worldwide. Companies use roll-on, roll-off vessels, which is what Roro stands for. Companies like Caterpillar, BMW, and Kia use those vessels to transport their fleet worldwide. So our team is made up of 3 co-founders, myself. I have 15 years in freight forwarding. I've shipped thousands of items on Roro vessels, and I've successfully launched logistics technology in the past. Our co-founder, Guillermo, is a 15-year veteran of sales and marketing. He has experience managing and training large teams with budgets exceeding $120 million. Our CTO, Hunter, is a quintuple threat, data scientist, programmer, mathematician with project management and product development expertise. So our self-funded, Florida-grown initial product launched in May. We have since generated nearly $100,000 in gross profit. 1/3 of which is from repeat business. Some of our customers actually include Ritchie Brothers Logistics, who's the shipping arm of the largest machinery auction in the world, and Ring Power Cat, who's the largest Caterpillar dealer in the Southeast. So our goal is to make Roro.com synonymous with shipping large freight worldwide.
Let's give him a hand. You want to stand or sit in the hot seat?
Whatever you like.
Okay. Tarek, great presentation. One of the things I think that I'll just give you more thought process, and with the total understanding that I gave you a very limited amount of time. There's no pitch deck, no anything. I think one of the things that first and foremost jumps out, and the things that, so you can see what's going on through our minds as a VC looking at this, it appears you have a very strong team. You have industry experience, which is important. What we don't want to see is, oh, well, I was a I was a doctor for a while, and then I thought of this IT thing, and then I had an opportunity to buy the company, and I'm going to found it. So you were in the industry, you saw a problem. That's really strong for us, and you're surrounded yourself with a strong team. That's really important. One of the things that I'd want to probably dig into more, you said you guys are the only one doing this. To me, that's rare. That may be true, and I'm not questioning your integrity, but when I see that a lot, I think a big problem is when people underestimate their competitors, and then we dig in and say, well, what about this competitor? What about this competitor? What about this competitor? And then we've kind of lost credibility in you. So that is not an indictment of anything about your credibility or anything. I'm just saying when I hear that, that's the first thing that I'm thinking is, okay, is there really any other competitors or not? So if you don't have any competitors, that's fantastic. That's really exciting. With that, I'd love to see is there a question you guys have direct?
Quick one. So you mentioned you guys had $100,000 in profits. Is that your sales, or is that clean profit, in your pocket? Top line revenue is $700,000. So great. So I'm gonna say something in 30 seconds. So I thought the pitch was really strong. There's a lot of founders that can't give a pitch in 2 minutes. So thanks for that. For those that are paying attention, he started out with a problem. Then went to his solution, talked about the team, and then the traction. That's all you got to hit, and that's beautiful. Obviously, you've done this quite a bit. The only feedback that I would give you is you could mention the $700,000 in sales. We've got $700,000 in sales, which has netted $100,000 profit. That's good for you to talk about $700,000 in sales.
Yeah, great job, by the way. It's hard to do a 2-minute pitch like that. Echo everything these guys are saying. I maybe would throw in something about market share or something like that. It's a bit of a niche, right? So for someone not familiar with that, may not realize, that there's a billion-dollar, multi-billion-dollar industry, right? And so I think that could help clarify a little bit there. But overall, I think it was very good, and I would, it makes you want to hear a little more. So.
Thanks a lot. We'll be in touch. Apply on our portal, and we'll take a look. Sure. So I'm told we're kind of out of time.